A lot of us in the middle income class think that we don't make enough money to actually build wealth. Well, today what we're talking about is how to build wealth regardless of your income. You have a certain level of income, you make $40,000, $50,000, $60,000 a year. This episode is for you because we're going to be talking about how to build wealth regardless of your income. If that interests you, stay tuned and let's go ahead and dive into the episode. What's going on, everyone? Welcome to another episode of the Success Spectrum podcast, where we dive deep into the world of finance, entrepreneurship, and personal development. I'm your host, Kadeem McLean, and today we're going to be talking about certain topics. One of those is budgeting. I know, forgive my language, people see budget as a cuss word, but we're talking about budgeting, saving, investing, because those are two different things, and the mindset shift that needs to occur to get you with your, let's say, average income to building wealth. All right. Doesn't matter what your income is, you can build wealth. Okay. So let's go ahead and dive into it because there's some basic strategies that we need to understand before we really go further. And one of them is something called your net worth. It's not necessarily about your income. A lot of people think because of their income, they cannot build wealth. And in the Millionaire Next Door, for example, there's certain studies that they did that says the vast majority of millionaires, they worked at it. They built it over time. They did not get a windfall or an inheritance. They built it on their own in their current generation. That means that you, with your level of income, you can do the exact same thing. Build wealth over time. Focus on your net worth, not your income. Your income is important, but net worth. So what is net worth? If you take all of your assets and you subtract your liabilities, that will tell you what your net worth is. Now, assets, those are essentially things that put money in your pocket. So we talk about the equity in your home. We talk about your investments, right? Your business, anything that puts money in your pocket, thriving business, mind you, things that put money in your pocket. If you have real estate investing or investments, those are, of course, rental properties. Those are also one asset. Now, liabilities is the outstanding mortgage on your home, right? It's your line of credit. It's your credit card. If you finance a vehicle or if you finance your phone, those are all seen as liabilities because it's a depreciating asset. It's not putting money in your pocket per se, right? So you take all of your assets, you subtract your liabilities, that will tell you what your net worth is. Now, don't panic because once you do that, a lot of you might be in the negative, and that's okay because this episode, we're aiming to give you some strategies that will help you dig yourself out of that hole and help you get onto thriving and building wealth for yourself and your family. There's something called the wealth formula. If you need a target, this is a target you can aim for. What the wealth formula says is if you take your age, you multiply it by your salary or your income, and then you divide that by 10. That is what your net worth should be for your age and your income level, right? So again, you take your age, you multiply it by your income, and you divide it by 10. That is what your net worth should be. Okay, so that's a target you can aim for if you need to. Now, just to emphasize, point one, net worth is something that we should focus on. We're talking about the basics right now. Net worth, not necessarily income. The second thing we got to focus on is growth, right? You got to grow wealth over time. It's not about, again, getting that windfall. Understand that it takes time to build these things. You're going to hear me say this a few times throughout the episode. It's not timing the market. It's about time in the market. We talk about time in the market. That means over time you build wealth. And we're going to talk about reasons why that's so important as we go on throughout this episode. Now, how can people build wealth on a regular income? The first thing that I say we got to look at is our balance sheet or our budget. All right. Again, excuse my language because some people see budget as a cuss word, but where's your money going? If you never looked at your balance sheet, you never looked at your budget, you have no idea what is going in and what is coming in. What is coming in and what is going out. You might think you do or have a decent idea, but you don't know every single dollar, every penny. You don't know where it's going. And until you do your budget, you won't know. Some of us think we're above a budget. And let me just tell you, you are not above a budget. Corporations, giant corporations, Google, Microsoft, Amazon, these companies do annual, quarterly financial reviews. That's a budget. That's a balance sheet. If they're doing it, What in the world makes us think that we're above a budget and we shouldn't do it or we don't need to? Do a budget regularly. I would argue once a month, at the very least, once a quarter. Do a budget, because now you know where your dollars are going, and it can lead us into our next point, which is to have a budget, to have a strategy, a financial strategy, right? And that is in terms of a budget. So there's different methods we can apply here. One of them is the 50-30-20 rule, which means 50% of your dollars should go towards your needs, 30% towards your wants, and 20% towards savings or investing. All right, that's a 50-30-20 rule. Another one is called zero-based budgeting. And essentially what this says is you're starting from scratch every period. So if you're doing your budget monthly, every month you start from scratch. You don't put any categories on there except for the ones you need. And then, of course, you kind of build up from there. What that helps you to do is eliminate unnecessary spending. Just because it was on your budget last month doesn't mean it needs to be on your budget this month. That's zero-based budgeting, right? And the last thing we can do here is set realistic goals. Because, and honestly, I would argue, me personally, set that realistic goal, but stretch yourself just a little bit. Not to make yourself extremely uncomfortable, but to get just outside that comfort zone. Because whatever number you set, it's likely you're playing a little too safe, and you can actually increase it a little bit to put it towards savings or investing. And once you set that goal, automate it. Automate it. You can set up automatic transfers in your bank account or automatic withdrawals to an investment account so that you don't even have to think about it. It takes the stress off of you. It takes the worry off of you, and it helps you to build it and stay consistent because it's automated anyway. By the time you look in your account when you get paid, it might already be gone. You might not even notice it. And that'll help you to maintain that habit and stick with the discipline and consistency to actually build that wealth over time. Now, we talked about our budget strategy, which is important, but where are we saving? Where are we investing? When it comes to saving, what you can do is put it into a high interest savings account. There's something called the GIA. I wouldn't necessarily say a GIC, but there's methods we can, not under your mattress. I'll put it that way. Because if you put money under your mattress or you just leave it in your bank account, you're losing money. To put it simply, you're losing money. Because again, there's this thing called inflation. The cost of goods and services rising over time. A car today does not cost what a car cost 15 years ago, 10 years ago. A cup of coffee from Tim Hortons or Starbucks is not the same price as it was back then. Right? A cell phone now is a mortgage payment. It's not the same as it was 10, 15 years ago, 5 years ago. It keeps going up, increasing over time. That's what inflation is. So if you put your money under your mattress or just leave it in your bank account that's earning you 0.05% interest, you're losing money. You may not notice it because the number is the same, but the buying power of your dollars is decreasing. Therefore, you are losing money. And it's funny because this is a bit of a side note. A lot of us feel safe because our money is sitting in our bank account, and we're fearful of investing because of the risk and loss associated with investing. There is risk associated with investing, but there's a certainty that you're losing money when you leave your money in under your mattress, leave it in an envelope, or you leave it in your bank account earning you 0.05%. You're guaranteed to lose money that way. With investing, at least you have a chance for it to grow. The choice is yours. You decide. I'm not going to decide for you. And now, a word from our sponsor. If you want to learn to amass your wealth in stocks, bonds, real estate, in commodities, if you want to learn how to protect your wealth or transfer generationally down the line in the way that you want it to be transferred, this book right here is a must read for you. The Legacy of a Silver Spoon, Managing Wealth and Relationships by Al Compton. You must get yourself a copy because you need it. If you want to do anything that I just mentioned, without reading this book, you're not going to be able to do it in the way that you want to get it done. You might not even know if there's different types of trusts or which type of trust you need. This book will help you in determining that. You might not even know what a stock is or what a bond is. This book will teach you every piece of information you need to know financially to get you from where you are to where you want to be. Go ahead and click that link in the description to get yourself a copy. So invest. Make sure you put your money to work. We work hard for our money. Why not make your money work hard for you? How do you make your money work hard for you? You can invest. Again, it's not time in the market, it's timing the market. So when you invest, there's some different investment options. such as index funds, ETFs, segregated funds, mutual funds, stocks. You can open up a Wealth Simple account or whichever platform, right? You can invest in your insurance plan, depending on what type of insurance plan you have. And we're not going to dive deep into that in this episode, maybe another one. But when you put that time in the market, what you're allowing yourself to do is utilize something called compound interest. Now, I don't know if it was the 8th and the 9th, but Albert Einstein said it was the 8th or 9th wonder of the world, however many there were at the time. Compound interest. What you're allowing your money to do is to work. It's basically compounding its efforts, right? So if you have $100 in there and you get $10 growth and you only contributed $100, now you're going to get interest on $110 versus just the $100 that you contributed. So it's compounding over time, right? So because if you expand that over the length of time, now you're getting growth on or interest on $200, on $500, and so on. It's just compounding for you over time. Okay, I'm not going to dive deep into the compound interest thing right now. But back to your emergency fund, rather your savings. The reason you might want to put your savings in something like a high interest savings account is because you have quick access to it if something were to occur, something were to happen. That means it's your emergency fund. Your emergency fund, if an emergency comes up, not an emergency vacation, but an emergency comes up, you pop the tire, right? Your transmission goes, whatever, something along those lines, right? You need quick access to money. Don't take from your investment, take from your emergency fund, because now an emergency popped up. That's what that's there for. Your emergency fund, let's say you need a month or two of expenses in there, just in case something were to happen. People will say 3 months to 6 months of emergency funds. Yes, I get it. But we're talking about our middle income class right now. And I would argue that you do need to have at least a month's worth in there. However, you can invest a portion of your emergency fund. So make sure you have at least a month's expense in your savings for emergency. But now you put an investment into low risk funds to actually grow your emergency fund over time, which is still separate from your actual investment account for whatever long-term goals you have. Whether it's buying a house, whether it's your wedding, retirement, right? Whatever goal you might set for yourself, these are two separate things. All right. Again, saving and investing, two separate things. Now, when it comes to investing, again, I talked about a little bit of the risk. There is risk associated with investing. So arguably, you don't necessarily want to invest more than you're willing to lose, is what people will say. There is risk associated with it, but how can we minimize some of that risk? One of the ways is diversification. Diversification means you don't invest into one company. You don't invest necessarily into one country, right? Or one sector. Sector being finance, health, energy, commodities. You don't necessarily invest into one sector. And that's where mutual funds and segregated funds and those type of things come in. A segregated fund is, in a nutshell, like a mutual fund, but it has different qualities. It has basically a life jacket on because it's from an insurance company. So there's certain guarantees and those things associated with it. Now, those mutual fund, segregated fund, you're getting a pool of stocks, let's say a pool of funds. And now you're spreading your risk, you're diversifying, because you might have some funds that are in Asia, you might have some funds that are in Canada, in Europe, in the US. Now you're not investing in just one company or country, you're investing in many different ones. So if one is down, the other ones might be up and you're still gaining money. Whether versus a stock, I should say, which is if the stock is down, no matter what, you're losing money. You only have the one stock. It was like investing in BlackBerry back in the day. If you invested in BlackBerry, at one point you were doing very well. But the idea is to leave your money in there, right, and let it grow for you. If you left it in BlackBerry, unfortunately, you lost a lot of money. But if you invested in BlackBerry, Apple, and Google at the time, you're still up because Apple and Google have done amazing and they're still doing amazing, even though BlackBerry went down. So that's called diversification, right? That's how you diversify your risk. Another way is something called dollar cost averaging. Instead of taking a lump sum, here's why a lot of people lose money in the market. They take a lump sum of money and they invest into a stock, a fund, whatever the case might be. And then they leave it there, never making another contribution, hoping it goes up over time. That's not necessarily going to get you what you're looking for. Because for the average person who's not familiar with day trading and watches the market consistently, that strategy is not really a strategy. Because what you're doing is you're taking, let's call it a gamble. You're taking a bunch of money, throwing it at the market to see what it does. Instead, what you can do is something called dollar cost averaging, DCA for short. And what that means is you are buying periodically over time. So even if you were to put that lump sum money in, or a portion of that lump sum, and then you consistently buy bi-weekly or even monthly, then now what you're doing is you're buying in the high times of the market and the low times of the market. This is an example I always use with my clients. Say you needed tissue and you walk into the store. Tissue is normally $10 a box, but you go into the store and it's $2 a box. You're probably going to buy more than one box because it's on sale. When the market is on sale, when Apple, Walmart, Google, they come down in price, guess what? A lot of people, those who have a savvy mindset when it comes to investing, they are buying more units or more shares when it drops because it's on sale. So if you're dollar cost averaging, putting in $250, let's say regularly every 2 weeks, then you're buying at that low point. Therefore, when the market returns, you have more units, you have more shares, and whatever the price is when it goes up, you've made money, ideally. So instead of just taking it all and dropping it in when it's at $10 a unit or $10 a share, it drops to $5, you lost money. It's hard to recover from that. But if you're doing dollar cost averaging and you buy again when it's at $5, it goes up to $6, you buy more, you've probably already made money depending on how much you bought when you were at $5. And if it keeps climbing and going back up, because the market's up and down, of course, but over time, the market is on an upward trend. And that's why we say it's time in the market, not timing the market. So hopefully that makes some sense for you there. Now, investing, I know I've been talking about a little bit here. If we're in the middle income class, right, again, making, let's say, $30, $40, $50, $60, $70,000 a year, we think oftentimes that we don't have any money to invest. If you made it this far in the episode, congrats to you, because you know that there's a way out. There is a strategy called the $7 a day strategy. So if you really think you have no money, first of all, you really need to take a look at your budget, because I'm telling you, you have money. But secondly, you can utilize the $7 a day strategy. And what this says is you go out on a regular basis and you might have a coffee. You might go and buy chips. You might buy a donut. You might buy a bagel. You might buy gum from the dollar store, from the gas station, a bag of candy, whatever the case is, right? Lunch on the road regularly. On a daily basis, you probably spend $20 to $30 that you don't necessarily need to spend. But let's just say it was $7, right? So $7 a day time, if you were to cut those out or minimize those or buy certain things at home in bulk so you can save a little bit, up to $7 a day, $7 times 30 is 21. What does that mean? That means you have 210. That means you have $210 that you can now invest every month that you thought you didn't have. Again, it's not necessarily about your income. It's not about how much money you make. It's about what you keep and where you put that money, what you do with those dollars that you have. When you look at your budget, you will be able to see the holes that are in your budget, and you'll be able to patch them. But if you don't take a look at your budget, you don't even know that there's holes. It's like a sailor. If you're a sailor and you have holes in your boat, but you don't inspect your boat, you set out to sea, you're gonna sink. And a lot of us are sinking without knowing it because we don't look at our boat. But if you looked at the boat beforehand, before setting out to sea, you could have simply patched those holes and it would have been smooth sailing. So I'm telling you, take a look at that budget, patch the holes, and make sure we set up a strategy to be able to build that wealth that we want to accumulate, to hit that number that we talked about with the wealth formula. Now, all of this, these are some strategies, some different methods that we can apply. But what's so important about all of this is the mindset. because you can set up these strategies and a month down the road, 2 months down the road, something might pop up and you're going to go back to your default, which is not investing, not saving, and continuing to buy those things that we know are liabilities instead of worrying or focusing on buying those assets. And when it comes to buying assets, I want to simply pause here and say this. You're not spending money to buy assets. You are simply transferring your money into an asset. Because at any point, for the most part, depending on what you purchase, you can transfer, or rather sell, let's say, that asset to get your money back and then some, because it's considered an asset. It will go up, ideally, in value over time. So you're not necessarily spending, but you're transferring your money. So, however, when you buy a liability, that's a purchase. That's you buying something, purchasing something. That's you selling, let's say, your dollars for an item that is going to decrease in value. Just a quick caveat there. Now, the mindset. We want to make sure we have a long-term mindset, because that'll help us to stay true to the goals and plans we set up in the first place. I know this isn't something that people like to hear, but we have to be willing to delay gratification. I have a previous episode that talked about time preference. We have to lower that time preference, because if we don't lower that time preference, these strategies that we set up, we're not going to stick to them. A month, 2, 3 months might go by. If you're good, you make it 6 months, but you're going to default back to your default, which is I'm not investing, I'm not saving because this came up and that came up and I don't have the money to save. If that happens, I encourage you to go back to this episode and listen to it again, because it's as simple as this. It's whether or not it's easy is another question. That's up to you, but it is simple, and we can build wealth if we utilize these strategies. Again, that long-term delayed gratification, time in the market, not time in the market. And again, the reason we say time in the market is because you look at the market chart. If the market was down 1 year, within, let's say, 12 to 18 months, it's already back up higher than it ever was before. If you stay invested, you continue to dollar cost average, buy over time, the market will return. That's the history of the market. It always returns, and it's always going up higher than it was previously. So that's why we say time in the market. Discipline, of course, is required, and financial literacy is required. So have a mindset of discipline your mindset, and a mindset of financial literacy, learning, growing, and adapting. And yes, all of this is great. All of this is important. But at the end of the day, that knowledge you're getting, that information, even from this episode, if you do not take action on it, it's pointless. It is absolutely pointless. If you do not take action on this, if you don't share this episode with somebody else to take action on it, you listening to this, I appreciate it, but I hope you do something with the information, because this is information that could literally change the way you operate, that could change that get that financial monkey off your back, get rid of that financial insecurity that you have, and help to build a sense of financial security, a sense of financial independence, because that's exactly what we're talking about and what this episode will help you to do if you utilize the strategies. That means if you take action on these strategies. Lastly, is to set long-term goals. Whether it's to buy that house, whether it's to retire early, whether it's to take a dream vacation with you, your spouse, your family, your kids, whatever that might be for you. Buy your dream home. Hopefully it's an investment, but buy your dream home. All of these potential long-term goals, you can pick whatever you want, set that long-term goal, make sure it's something that you actually want. That way, you know, you'll stick to it, and you'll set up a plan and stick to that plan, stay disciplined to achieve that desired goal. Without a goal, again, that financial map, you need to know 2 points. One is where you want to go. The other is where you currently are. You can know where you want to go, that destination on your financial map, but it means absolutely nothing if you don't do your budget and know where you currently are. Why? Because without knowing 2 points on a map, you have no idea what route you need to take, what hills you need to climb, what valleys you need to go into to be able to get to that destination. Until you know those 2 points, you're lost. You're a wandering generality. Figure out those 2 points, come up with a strategy to help you get to that destination. So quickly to recap, there's so many different budget strategies we can utilize. Pick the one that is fitting for you. Pick the one that fits you, your lifestyle, and is in alignment, let's say, with who you are and your mindset. Pick that budget strategy. Save consistently. Invest early. The best time to start was yesterday. The next best time is now. Start now if you haven't started already. Start investing now, because again, the power of time, the power of compound interest will work in your favor the earlier you start. But it works against you if you don't start now. And lastly, keep learning, keep adapting, and keep growing. All right? Remember, every step you take is a step towards becoming the optimal version of you, mentally, physically, emotionally, and financially. All right? So hopefully this episode was helpful for you. Kadeem here, and I'll see you in the next one.